Well, Art, when it comes to a reverse mortgage, I want to ask you something about the idea of a reverse mortgage versus HELOCs and refinancing, because I know there's something tricky there that, as senior homeowners are, let's say the income has gone down, the wealth is there, it's in their home, but typically to qualify for these, don't we have to have a nice income to cover that? And is that a problem?
Well, absolutely. In fact, that's what happens quite often. When we end up originating a reverse mortgage, it's not uncommon for that to have occurred because that senior homeowner first came to us and said, "Hey, I own a home that's worth 950,000, and I have a $200,000 mortgage on it. And I can handle the payments on that okay, but I need to get some cash out. I want a $250,000 home equity line of credit."
Mm.
So we'll say, okay, and we'll show them the numbers. And then we look at, they decide they want to pursue it. We look at their ability to qualify. And here's the problem. An equity loan, second mortgage, whether it's a fixed rate or a HELOC, you have to go through the ability to repay qualifying guidelines. So we have to thoroughly document your income to establish that you have a certain specific amount you're receiving on a recurring monthly basis, stable over a long period of time. And then we have to evaluate your other consumer debt payments and your existing first mortgage payment, if there is one, plus the equity loan payment that you're applying for. Put it all together, and is those payments, monthly payments for everything divided into your income, is that ratio going to be under, say, 50%? If
Mm.
it's not, you can't get that HELOC or fixed rate loan or that cash out refi. You don't qualify because your debt ratio is too high. We run into that quite often because, again, their income is more limited. Now they get very upset and frustrated, because in their logic, they're like, well, wait a minute. I owe 150 in my first. I want 250 in my second. It's 400. My house is worth almost a million. Why isn't that good enough? Well,
Mm.
that's all about the history of '08 crash, and people were qualifying without determining if they can qualify for the payment. Now you have to do that. So that becomes the segue into, okay, we can't get you qualified because your debt ratio is 68 on a HELOC. But you know what? You have enough equity. We can get you a reverse mortgage that will pay off your current first, give you the remaining portion as a line of credit. Again, that HELOC that you wanted, and you can set that up with a zero balance initially. And the benefit of that is it grows over time, and then you have it there to use when you need it. It's sort of
Mm.
basically a rainy day fund, almost like a savings account secured by your home. So that's the way to. So that's how. Yeah, I want a HELOC turns into, give me a reverse mortgage that still gives me a line of credit that's actually better than a HELOC, because the reverse mortgage line of credit grows over time. The traditional HELOC does not.